Hello, I'm David Frazier with Investors Monitor, and this is our weekly market wrap show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to impact the value of your investment portfolios. Well, we're recording today's show, our first market wrap show, on Saturday, January 2nd, 2016, which is airing today on our internet website at www.investorsmonitor.com at 8 o'clock p.m. on Saturday, January the 2nd, 2016. First, I wish all of you a very happy and prosperous new year for the year 2016. And on that note, let's just get started. Well, many of you who are likely watching this show know from the last TV show that we recorded on December 23rd, I told you that even though the Federal Reserve had decided to raise its overnight lending rate, that is the Fed funds rate, there was really no reason whatsoever for the Fed to raise that rate other than to stop all the chattering that's been going on for more than a year by so-called financial market experts who claimed repeatedly over the past year, and really up to even a year and a half, that it expected the Fed to raise rates because the economy was continuing to show signs of improvement. And you probably also know, that is, those of you that watched that TV show recorded on December 23rd, that I told you that the Fed said in its release, its issuance to the press, its statements to the press, I guess I should say, on that day, that among the reasons that it decided to raise the short-term lending rate, the overnight lending rate, and by the way, you often hear that the Fed raises rates. The Fed raises interest rates. No, the Fed does not raise interest rates. The Fed actually has control over only one interest rate, and that is the overnight lending rate that commercial banks lend to one another, the Fed funds rate. Yes, it's true that the level and direction of the Fed funds rate has some impact on longer-term interest rates, but actually very little impact. But anyway, having said that, the Fed said on December 23rd, when it announced to the world that it had decided to raise the Fed funds rate, that among the reasons that it increased that overnight lending rate was, quote, household spending and business fixed investment have been increasing at solid rates in recent months, unquote. And once again, those of you that watched that video, that TV show that we recorded on that day, know, as I told people in that show, well, I don't know what the Fed means by household spending and business fixed investment increasing at solid rates, because the rate of increase in household spending trended lower, slowed, that is, declined actually, the rate of increase over the past 6 months, during every month over the past 6 months. It might be 5 months, it's 5 or 6 months. And business fixed investments actually declined, not at the rate of increase, they actually declined during the most recent quarter. The data is available, that's the quarter ended September 30th of this year. So there was no reason for the Fed to raise the overnight lending rate. It did so, but my opinion is simply to just get it out of the way, because so many so-called experts have been expecting the Fed to raise that rate. Well, and what's happened since then? Here's what's happened since then. We've had data on some very important economic indicators indicate very strongly that the pace of economic growth here in the United States is likely to slow over the next few months. And let's just give you a few examples of why I say that. Well, first of all, on December 23rd, we got more information, not just the quarterly figures for personal spending, that is personal consumption expenditures, but actually for the most recent month, really not December, but for November, and personal spending had slowed again. We got information on December 30th showing us that a contract signed by prospective home buyers to buy a home within the next 2 months have trended lower for 5 months in a row now. And we got a report also early last week showing that the sales of previously owned homes had already declined over the past few months. So this report issued on December 30th shows that sales of previously owned homes is likely going to continue to move lower. And that's very, very important, because history has shown that the direction of the overall economy over at least the past 50 years for the United States has moved in the same direction as economic activity in the housing market. And so if we're going to see a slowdown in the housing market, which we likely are, well, the pace of economic growth is going to likely slow. And additionally, the U.S. economy is also very closely tied to, has been for at least the past 50 years, economic activity in the manufacturing sector of the economy. And we got the Institute of Supply Management. This is an organization that does surveys every month of thousands of purchasing managers at manufacturing companies. The Institute of Supply Management found during its most recent survey that was completed during late November that manufacturing activity here in the United States was probably going to decline during December. We don't have the final results out regarding that yet, but it looks like that probably is the case. And one thing that we do know more about is we got more recent reports regarding manufacturing activity over the past couple of weeks from the Federal Reserve Bank of New York, as well as from the Federal Reserve Bank of Philadelphia, and the Institute of Supply Management in Chicago, the Chicago division of that organization of purchasing managers. And what we see is that manufacturing activity in the Philadelphia area slowed considerably during December, and I'm not sure. I need to take a quick look at that, and I'll tell you in a few minutes where you all can also look at these types of economic indicators on our website. Quickly, I'm going to look at a chart. I think it actually declined, not just slowed. And sure enough, we saw that manufacturing activity actually declined in the Philadelphia area during December after slowing substantially over the prior few months. Let's see, and then let's see, when was it? Just one moment, please. And then on December 30th of last week, we got a report out from the ISM Chicago showing that its Business Barometer Index, which is based on surveys, once again, to not only manufacturing purchasing managers, but also business executives at other types of businesses, indicated that economic activity that it slowed considerably over the past few months and also declined in the Chicago area. So I know I'm kind of all over the place here, but let me just summarize by saying that personal spending, the rate of increase in personal spending here in the United States has slowed during each of the past 5 months. Business fixed investments in capital goods and manufacturing equipment and industrial facilities declined during the third quarter of this year. Numerous indicators suggest that economic activity in the housing market is slowing considerably, and numerous other indicators, reliable indicators, are showing that manufacturing activity is slowing, if not declining, in the United States. So what does that tell us? It tells us that the pace of economic growth here in the U.S. is likely to slow considerably over the next few months. And that's very, very significant because the corporate, the revenues and bottom line profits of most companies, privately held companies as well as publicly held companies, is very related to, very strongly correlated with the pace of economic growth, and that shouldn't be surprising. I mean, if the economic environment is improving, people and businesses are likely spending more money, and business revenues are likely increasing, therefore the profits are likely increasing. But if just the opposite occurs, that is, if we see a big slowdown in the economy, that means business revenues are likely slowing, the pace of increase, if not declining. And therefore there's a good chance that corporate profits are going to stagnate or decline. And stock prices are determined ultimately by the level and direction of profits. So, you can listen to the Fed and being somewhat cryptic in what it tells the world, or you can just look at the actual data. We do very little reading of newspaper and financial magazines or watching other financial broadcast shows here at Frazier and Mayer Research, LLC, the providers of Investors Monitor. Instead, we just look at the data, and we go with what the data tells us. And we've been very good at looking at the data over at least the past 15 years in being able to correctly forecast major peaks and bottoms in U.S. stock prices. That is judged, or is not really judged, but is illustrated by the major U.S. stock market indices. We've been very, very, very accurate at forecasting peaks and bottoms in the major U.S. stock market indices for at least the past 15 years now, within just a couple months of those peaks and bottoms. So what I'm telling you, therefore, or encouraging those of you that are watching this show, is you need to get defensive. And that doesn't mean by investing in big company dividend-paying stocks. Because those big company dividend-paying stocks, guess what? They also go down in price when the pace of economic growth slows. And they often decline in price pretty substantially when you have stock prices in general pull back. So that's not getting defensive. That's a bunch of nonsense. If you want to get defensive, you go to cash. You put your money in money market securities. And the reason being is you're not going to lose any money by doing that. No, you're not going to make money, but you're not going to see any decline in the value of your portfolio. Now, I realize that a lot of you rely on your investments in securities to pay your regular recurring living expenses. And therefore, we are continuing to advise persons who subscribe to our investment journals not just to allocate a large portion of the financial market assets to cash-like investments, that is money market securities, and at least 70% that we're advising people to allocate to money market securities. But we're also recommending for persons who rely on regular income for their investments to invest a portion of their money in the Gabelli Equity Trust Series H Cumulative Preferred Stock. That's ticker symbols GAB-PH, GAB-P is in Paul, H is in Harry. Welltower Inc., symbols HCN, that's a healthcare REIT, and the Nuveen S&P 500 Buy Right Income Fund, symbol BXMX, that's Boy X-Ray, Mary X-Ray. And most of you have probably never heard of those fixed income securities before. And I don't know why. It's probably because these so-called financial advisors don't get paid a good commission off recommending them. But if you want to learn more about the securities, I encourage you to go to our internet website at www.investorsmonitor.com. Put your mouse over the gold-colored menu bar near the top, where you'll see individual services, and then you'll see free weekly commentary. If you click on that and then click on the weekly commentary dated December 23rd, 2015, you'll be able to read about those securities. So, thank you for listening. I hope you got something out of this show, And remember, our mission is simply to tell you everything that you need to know, but nothing more. So sometimes this show might be only 5 or 10 minutes in length. Sometimes it might be up to 40 minutes in length. It just depends on what's going on in the financial markets and what the indicators that we've relied on for a lot of years that have helped us to call major turns in the financial markets. It's whatever those indicators are telling us. So I hope you tune in again next week. And once again, I thank you for watching and listening. Have a good evening.